Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Here's what we're watching this hour. First up, we're going to push ahead to Nvidia earnings as the AI chip giant reports results this week. We'll preview what to expect from the September jobs report and what it means for the Fed. And Bitcoin wipes out its year-to-date gains. We'll get a check on the token and hear from investor Michael Saylor on the recent sell-off. Let's take a look at the major averages here today. After last week's sell-off, a little bit of a bounce back in parts of the market today. The Dow is still lower here, but only very marginally. The S&P 500 bouncing by about 1/5%. The Nasdaq up by about 0.4% after some volatility that we saw last week. Really, it feels like a little bit of a waiting game here today because we have that jobs report coming before the open on Thursday. By the way, we'll also get earnings from Walmart that day. And of course, after the close on Wednesday, we'll get Nvidia numbers. So investors kind of waiting for those big catalysts this week. Let's dig into Nvidia a little bit more because indeed it will report its third quarter earnings this week. Investors looking at the chipmaker's results as a test of the AI trade. Joining me now, Antoine Chikaiban, a New Street Research technology infrastructure analyst. Antoine, it's good to see you. There have been, it feels like, some big expectations, maybe as always, put on Nvidia. But they were perhaps heightened even more by comments from Jensen Huang at their GTC event in Washington, D.C., where he talked about the big backlog for Nvidia. So what did that do to your expectations?
Hi, Julie. Thanks for having me on the show. So yeah, I mean, Jensen's comments in Washington, he's talking about booked business, booked Blackwell and Rubin business over 2025 and 2026 cumulative. That's 500 billion of book business that Nvidia has. And if you look at the sequential trajectory that this implies for the business, it implies that Nvidia is going to grow its data center revenues, close to 20% sequentially every quarter from now until the end of 2026. And if you look at expectations, actually at consensus expectations, they definitely don't reflect that kind of upside. So that's one thing. And then if you look at, things from another angle, if you look at it, top down and how much Nvidia's major customers are planning to invest, so, like the CapEx plans of Amazon, of Google, of Microsoft, of Meta, actually they're very consistent with such a sequential trajectory. So bottom line is we think that the setup is looking very good for Nvidia from multiple angles for the coming quarter and entering 2026.
Antoine, what do you expect to hear about supply from Nvidia? Because we know, or at least we seem to know, that demand is out there. In the past, the company has had some bottlenecks for supply. Do you think that is still going to be an issue?
So there are multiple levels, where there could be some bottlenecks. So you have, like manufacturing the GPUs themselves. For example, you need a lot of HBM memory, you need a lot of CoWoS to package all that together and make the chip. I think Nvidia has worked very hard to secure supply, and I'm not too worried that this could be a bottleneck. There could be a bottleneck at this part of the supply chain. If you look, further down, so you have, for example, CoreWeave talking about some issues in rolling out powered AI shells. I think for now the issue is mostly isolated and probably related to the scale of the company. If you look at the Nvidia's largest customers, I think they probably have a more diversified set of partners with whom they're rolling out these shells. So we're less concerned. And then lastly, everybody's been talking about power as an issue, like actual power, actual gigawatts. I also don't think that this is going to be an issue because there are a lot of efficiencies that we can find throughout the supply chain. So I'm not too concerned about supply being an issue in 2026.
Let's talk about the stock for a moment here because, yes, it's up something like 40% this year, but 5 of the past 8 reports, even when the company has beat, and it's usually beat, the stock goes down 5 of the past 8 times. As I mentioned, expectations are high here. So do you expect the stock to perform in line with maybe the beat that we might see from the company?
I mean, at some point, the earnings power of Nvidia, so if they actually, deliver on the booked business that the CEO shared at GTC in Washington, that means that earnings are going to approach, $9 next year, Okay, so the stock is trading like on low 20s today, that number. And as we move into 2026, the stock is going to start trading on 2027 numbers. And we already start to have a lot of visibility, from, for example, Amazon telling us that they plan to double their data center footprint between now and 2027. I think Microsoft made some similar comments. When you listen to Satya, he's telling you that the rollout is progressive and that, all these comments are making us very, optimistic about 2026 not being the peak. And so at some point, these numbers have to start getting reflected into the stock. So actually, we see the setup as very, very strong for Nvidia as we enter next year.
Antoine, if 2026 isn't the peak, when's the peak?
That's the question of the bubble. We never know when the bubble is going to burst. That's the real question about the bubble. What I can say is that near term, we already have very strong signals. 26 is really well set. I think, 27 will already start to have good visibility. Now, if we look further out, I think the question is really how much capex can the economy absorb? Can the global economy absorb, And we've done a lot of work on that. We call that our replatforming general theory. And actually, there's plenty of room for the entire economy to absorb, north of $3 trillion of data center capex. We're still at $500 billion next year, for the top 4 hyperscalers. As long as the economy can extract productivity gains and continue to grow, with all this infrastructure, there is no reason to stop investing. Now, of course, we could see a pause at some point. We could see, one of the hyperscalers, for example, try to replatform too quickly, invest too quickly in its infrastructure, invest too quickly in its cash costs, so for example, in its workforce. And that could result in margins compression, that could result in a slowdown in investment. We don't know exactly when that's going to happen, but it's always a risk. But there is definitely a scenario in which between now and 2035, global data center spending, grows like 10x. So there's still plenty of room for the bubble bursts.
Does it give you any cause for concern that SoftBank and Peter Thiel both have announced they've sold their Nvidia shares in the past week or so?
I mean, for example, SoftBank sold its Nvidia shares, but to invest in OpenAI. So,
right.
It's always, where do you see most upside? And I think, there's still a bit of a question mark on if you take like the entire AI infrastructure stack from chips all the way to models and applications, some have a different view on which part of the stack is going to capture most of the value. It's not, to me, any reason to be concerned.
All right, Antoine, great to see you. Thank you so much.
Really happy to see you, Julie. Thank you.
Much more markets action coming up. Next, we will be talking about the upcoming September jobs report and what to look for. We'll be right back. Wall Street will get a clearer picture of the nation's labor market when the September jobs report finally comes out Thursday morning. It'll also be closely watched by the Federal Reserve, of course, as it grapples with a possible rate cut next month. With me now is Gus Fauché, PNC Financial Services Group Chief Economist, and Yahoo Finance Federal Reserve Correspondent Jennifer Schonberger. Before we get to the jobs report this week, I do want to get to some Fed commentary that we got today, Jen, from Philip Jefferson. So we've been getting a lot of Fed speak as of late. What did he have to say?
Yes, the week kicking off with Fed Vice Chair Philip Jefferson, who said that over the past couple of months, the balance of risks have shifted more towards the labor market. He sees greater downside risks to the job market compared to upside risks to inflation, though he says the Fed needs to move more slowly. He indicated in a speech this morning in Kansas City that the Fed is much closer to neutral and that, quote, the evolving balance of risks underscores the need to proceed slowly as we approach the neutral rate. And something that stuck out to me in his speech that was quite nuanced was when he was talking about both sides of the risks to the dual mandate, he noted that upside risks to inflation have likely declined somewhat recently. And this is noteworthy because, as you said, we have heard from so many regional Fed bank presidents over the past couple of weeks who are more concerned about inflation being sticky here and probably more in favor of holding the line in terms of holding rates steady come December. we know that Jefferson is the vice chair of the Fed and thus very close to Fed Chair Jay Powell, who tries to create consensus here in the committee. And so this is kind of a little bit of a departure from what we've heard and seen from voting members over the past week who have been more in favor of holding the line.
Really interesting. Gus, should we read that Jefferson commentary as a proxy for Powell? Or, I mean, what are the tea leaves telling you about what the Fed's going to do?
I think that Fed officials have made it clear that they're going to proceed more cautiously now about rate cuts than they have over the past few months. Vice Chair Jefferson indicated that inflation, the risk to inflation may have receded somewhat, but I think they're still elevated. Inflation is still above the 3% objective, and we're still getting a lot of commentary that Fed officials are concerned about inflation. So I do expect them to be more cautious going forward. That being said, I do expect to see a 25 basis point rate cut when the FOMC meets in mid-December. A lot of that will depend on, however, on the data flow, and we're starting to get a resumption of that, and that's going to be the key to their decision.
And Jen, let's go to you on the September jobs report and what to expect here. To Gus's point, we finally got our first government report this morning that we hadn't had in a while. Construction spending was up 0.2%. This is an August number, by the way. And we're only going to get September jobs coming up later this week. But what are economists on average looking for, Jen?
Yeah, it's going to be a bit stale, right, Julie? But yes, finally, we are going to get that September jobs report. And by the way, Jefferson acknowledged that they're going to be heading into this next meeting with not as much data as perhaps they would have hoped. And so it is much more, quote, prudent to take a meeting by meeting approach. But we are expecting that the job market had rebounded a bit in the month of September from August, with payroll growth increasing to 54,000. That would have been from 22,000. Again, this is back in August. So this is quite stale. The unemployment rate expected to hold steady at 4.3%. Average hourly earnings year over year, 3.7%. So we'll also have to look at revisions as well. Was August revised downwards? Was it revised upwards? I have also reached out to the Labor Department to understand whether we will get initial jobless claims on Thursday, which is when they are typically released, because that will give us a more real-time signal of the state of the job market.
Right. And Gus, I mean, if this is a September number, what do we even do with it at this point, considering that it is, sort of more dated?
I think it does tell us something about the state of the labor market. In particular, I think private sector job growth for September is going to be important. We do expect to see some of the impact of the DOGE cut showing up in the government employment numbers, government sector employment numbers, and then hopefully we'll have the October report before that mid-December FOMC meeting. But I think that between jobless claims, between at least a September jobs report, between the ADP employment report, and so forth, that should give a fairly good read on where the labor market is at the end of 2025 and allow the FOMC to determine how close they are to that maximum employment part of their dual mandate and see if they need to cut rates in order to support the job market.
What's your assessment, Gus? Given some of the private reports that we have had, do you think the job market is holding up? Certainly consumer sentiment doesn't think it is.
We think that the jobs report will show 40,000 jobs added in September, with the unemployment rate holding steady at 4.3%. Again, I think that the private sector is going to account for all of the job growth that we do expect to see federal government workers cut over the month. But it's difficult to tell in the current environment how much of the weakness, the slowing in job growth we've seen this year is due to labor supply versus labor demand. We're just seeing a lot fewer people enter the labor market because of restrictions on immigration and increased deportations. So that's slowing job growth. If it's because of labor supply issues, that's less of a concern than if it's that businesses don't want to hire workers because they're concerned about the economic outlook. So we do need to get more clarity on how much of the slowing in job growth is coming from the demand side versus the supply side.
Well, and Gus, how many more reports? Like what exactly do we need to make that conclusion?
I think we're going to be looking at things like the JOLTS report, the Job Openings and Labor Turnover Survey, and obviously that's been delayed by the shutdown as well. We're going to be looking at surveys of businesses and their hiring intentions and so forth to determine whether businesses are cutting back on the number of job openings that they're posting, the number of workers that they're hiring, or if they want to be hiring, but they just can't find the workers, and that's accounting for the slowdown in job growth that we're seeing.
Well, and Jen, obviously, the kind of conundrum that's facing Gus in terms of how to make these conclusions is the same conundrum that's facing the Fed, and helps explain why there appears to be this split going on.
Yeah, absolutely. And, I think Fed officials are looking towards that gold standard of government data to try to get some more clarity. And from what I can tell from many Fed officials I've listened to, they still expect some fog here as we go through the year. But one member of the Fed who's thrown cold water on this notion of we're in a fog right now is actually Fed Governor Chris Waller, who we're going to hear from later this afternoon with his economic outlook. And he's been on the record saying that he is in favor of another rate cut in December. He feels that they have enough right now with the private sector data, surveys, the Beige Book, and so on and so forth. But if you'll recall back during the press conference, Fed Chair Powell seemed to sort of indicate that he thinks more of what's going on in the labor market here is supply oriented as opposed to demand. And so I think Fed officials are going to want to see that continue to be borne out in the data. If September comes in as expected, I think that holds up that thesis that we are because of immigration, there are less supply of workers, less need or demand for workers. And so there's a lower what we call break-even rate. So that holds up that thesis. At the same time, we've been hearing anecdotally, we heard about it at our Invest conference last Thursday. I've heard about it from Atlanta Fed President Raphael Bostic, that companies know we're not in an environment right now where they can pass on higher costs from tariffs to consumers. And so they're looking for ways to absorb that cost. Perhaps they've done that already through the supply chain. So do they also do that through headcount? Because labor costs are a big cost for companies as well. So these are all issues that the Fed is trying to sort through.
Yes, indeed. Gus, Jennifer, thank you so much. Appreciate it. Well, Jen just mentioned Yahoo Finance Invest. It highlighted some of the top leaders in AI and crypto last week. Here's a look at some of the biggest moments from the event.
All these things we've been saying for 20 years, and you know what? They pissed off a lot of people in the league. I run into people all over America, and quite frankly, all over the world. People who have like normal means who are now rich because of Poundgy.
The math is pretty simple. We expect Bitcoin to appreciate about 30% a year for the next 20 years. There's no doubt in my mind Bitcoin will be a larger asset class than gold by the year 2035.
It shook us all to the core because fans need to trust that they are seeing real-time competition and that the outcomes are fair.
It was 9 p.m. in that AI party. It's now 10:30 p.m. But that party goes to 4 a.m.
There are elements of a bubble, which means that people will end up with losses. But the aggregate value of what's being created is significant. It makes sense to take a venture capital approach to AI. The payoff is so large that it is rational to have multiple investments and to overinvest.
The economy at the top level is strong, but again, it's being driven by this really important set of investments in AI. The rest of the economy under the hood is really stuck.
Government's going to change, tariffs going to change, leaders going to come in and out, and various other things are going to happen. You can never put all your eggs in one basket. That's always been the rule.
Vaccines have saved the world and will continue doing that. In the long term, it's the most cost-effective medical healthcare intervention.
We make an investment, and the management team, the day after we make that investment, I can promise you, they are getting together and they are going to do more than they would have done, faster than they would have done.
Most companies, when they think about their business, dealing with retail investors is pretty secondary or ancillary. They're worried about making sure that they're launching products. Our business is inherently different. Retail investors are at the core of not just our investor base, but also our customer base.
We're mining Bitcoin for roughly 50 cents on the dollar every single day, 24 hours a day. We're mining Bitcoin, and we're adding it, and we believe this asset's going to be transformational.
Things were looking great. Then all of a sudden you have a shutdown that occurs, something that comes completely out of your control. We can't do business like that. We need more, from our government leaders.
Coming up next, the top calls of the day. We'll tell you what analysts are saying about Dell and Block. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Allie Canal, live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. We're watching Block, Dell, and Vita Coco. First up, Block. Shares moving slightly higher today. Looks like maybe possibly to the downside at this point after Truist upgraded the stock to hold from sell and nudged its price target to $68 ahead of Wednesday's Investor Day. Truist saying that the risk reward finally looks a bit better after the recent pullback, pointing to improving momentum at Square and a view that the market has already priced in most of the concerns around Block's shift toward more lending. But the analyst is still uneasy about credit risk, especially given the fast growth of Cash App Borrow. Shares of Block are still down about 30% so far this year. Next, Dell. Morgan Stanley is getting a lot more cautious, cutting Dell to underweight from overweight and slashing its price target to 110 from the prior 144. The firm thinks rising memory costs could squeeze hardware margins next year, making Dell one of the companies most exposed. The market seems to agree. The stock is down around 7% early trade, but there's a split view on the street. JP Morgan actually put Dell on a positive catalyst watch, saying that demand from cloud customers could drive better near-term results. Dell reports earnings on November 25th. Finally, Vita Coco. Bank of America upgraded the stock to buy from neutral and raised its price target to $54 from the prior $48. The move is all about tariff relief after the White House said it is excluding coconut water from reciprocal tariffs, removing what had been a major overhang for the company. BofA had been modeling a $37.5 million hit in 2026, which is now off the table. And with that risk gone, the firm raised its 2026 profit outlook and said easing freight costs and solid demand should keep coconut water one of the few categories growing in both volume and price on solid footing. We'll keep it right here on Yahoo Finance. We'll be tracking all the market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching Johnson & Johnson, EW Scripps, and Sealed Air. First up, Johnson & Johnson. The company agreed to buy cancer treatment developer Halda Therapeutics for $3 billion. Halda testing an innovative new type of oral therapy for prostate cancer. The biotech is also developing treatments for breast, lung, and multiple other tumor types. The purchase part of a strategy to cope with eroding sales for J&J's major psoriasis drug. Next is EW Scripps. Sinclair Broadcasting has taken an 8.2% stake in the news media company, part of a potential merger strategy, according to a 13D filing. EW Scripps said its board will protect company and shareholders from the, quote, opportunistic actions after Sinclair disclosed that stake. Sinclair's indicated $300 million in annual synergies in the event of a Scripps deal. And Sealed Air agreeing to be bought. It's the inventor of bubble wrap, and it's agreed to be purchased by Clayton, Dubilier, and Rice for $6.2 billion. The company traces its roots to 1957, when engineers invented a new wall covering by laminating two plastic sheets with air bubbles in between. The private equity firm CD&R is going to pay $42.15 a share for the packaging company. The share is actually down a little bit today. Coming up, Michael Saylor weighs in on the crypto market at Yahoo Finance Invest. Stay tuned. You're watching Market Catalysts. Bitcoin erasing this year's gains after falling below $94,000. Strategy Executive Chairman Michael Saylor joined us at Yahoo Finance Invest to talk the state of crypto. Here's part of that conversation. Obviously, you're a serious guy, right? We've talked a number of times. You think very deeply about all these issues. But then sometimes I look at your X account and I see you posting or reposting these various sort of digitally generated images, AI generated images of yourself. They're a lot of fun, right? Of you, we're showing one of you in a top hat, various Bitcoin paraphernalia, superheroes, etc. Like, you know, I'm just curious how you think about that. Is that, you know, is your Bitcoin advocacy? Is there an element of shtick to it as well? Are you having a little fun with it? How do you think about all of that?
When I was growing up, there were 3 channels on television, and they turned off the television, the signal at like 11 o'clock at night or midnight, and for 8 hours there was no programming. There was no internet. We didn't have, today, we have infinite free music, infinite free television, infinite streaming video, infinite free YouTube. You can get lost, fall in a TikTok hole, an Instagram hole. You can get on stream and Twitch. We have managed to manufacture infinite everything. It used to be you had to have money to get a newspaper or a magazine. And now you can see we live in a world where we have, to say 1 million times more content would be probably an understatement. So the entire society is being inundated with information, and their attention span has shrunk. And so people just don't have an hour to listen to what you have to say. Sometimes they don't have a minute. Oftentimes I think, should I say it in a podcast? Well, maybe someone will listen to it. Can I say it in 5 minutes? That might be too long. Can I say it in 30 seconds? Sometimes I'll write a paragraph and you think, no, I don't have a paragraph. People will read the first sentence. And then I write the sentence and I think people aren't going to read to the end of the sentence. And so the thing you learn from social media is you need to get to the point. So how about tell me what you want to say in 1 second? And the cliche is a picture is worth 1,000 words. And so sometimes I don't give you 1,000 words because you would lose 99.9% of the audience. In fact, I would say you'd probably lose 99.99% of the audience if it took 1,000 words. Show me the picture, and that will go viral. And you're doing people a service to give them an idea that travels 1 million times faster, that is 1 million times easier to digest, because people just don't have time. They're busy. They're being inundated. And when you see those images, that is us communicating something cheerful, constructive, useful, perhaps profitable to someone. But like if someone says, hey, I wrote a book on this, here's the book, do you want to read it? I mean, how many books can you read? Literally every book written in the history of the human race is available for free to you right now. Do you really want someone with a good idea to give you 250 pages and tell you to read it? Or do you just want them to boil it down to 1 sentence, 1 tagline, or 1 picture? Because I'm like, show me the picture. Okay, got it. Now I can move on with my life. Thank you.
You're making a lot of sense to me, Michael. Stay with us for a second. Let's bring in our social correspondent for the day, Yahoo Finance's Ali Canal, with some of what she's hearing from our online audience during this interview. Ali.
Yeah, well, Brian, Michael Saylor just talking about infinite content on social media, which is the perfect segue since we are talking and taking your questions on social media. Plenty of viewers chiming in, and starting off with a strong one here, Michael. First question, do you see Bitcoin catching up to and surpassing gold's market cap by 2035? What say you?
I do. I think we're in a Bitcoin. We're in the digital gold rush, and 2035 is the 0.99 year. That means that 99% of all the Bitcoin will have been mined in the year 2035. If you want Bitcoin, you need to get it between now and then, because the last 1% of Bitcoin comes out over 100 years. There's no doubt in my mind Bitcoin will be a larger asset class than gold by the year 2035.
And another social viewer wants to know, why should an investor buy strategy stock instead of a Bitcoin or spot ETF?
Yeah, if you don't want to take any counterparty risk, and if you have a long time horizon, then you should probably buy the Bitcoin because you can take custody and take it anywhere in the world. If you simply want the asset, you want it in a brokerage account, you should buy the ETF like IBIT. It's going to take you 10 seconds to do that. It's easy to borrow against it. If you're a believer and you want amplified exposure to digital capital, and also if you believe in digital credit, like our mission at Strategy is we want to give 1 billion people a bank account that pays them 10% tax deferred. if you think that's a cool idea to give someone in Japan or Europe or Switzerland or New York City a bank account that pays them 10% with no volatility, and if you think that Bitcoin can power that, then you're buying our stock because we're a digital credit factory. And if you want to outperform Bitcoin and you're ready to get on the roller coaster, you should buy the equity. But if you're short, your time horizon is less than 4 years. If you need the money back in 4 weeks or 4 months, then you probably want something principal protected. You want low volatility. You should buy a credit instrument. Like STRC is literally designed to get the vol, down. Right now it's 7, whereas Bitcoin's vol is 45 and Strategy's vol is 65. And if you want something that's going to be extremely low vol, you should buy a credit instrument like a treasury credit product like STRC. You'll outperform your money market. You might very well do as good as the S&P index, but you'll be able to buy it and sell it and get your capital back, in a month, in a quarter, in a year, and you don't have to, worry about the roller coaster.
The median age of home buyers has reached 40 in 2025. It's the highest in U.S. history. High home prices and interest rates have contributed to a relatively stuck market that's... We'll be right back talking about that. The median age of first-time home buyers has reached 40 in 2025. It's the highest in U.S. history. High home prices and interest rates have contributed to a relatively stuck market that's on pace for the slowest pace of existing home sales growth in a quarter century. So what's it going to take to unstick it and bring in new buyers? Let's talk to Meredith Whitney about that. Meredith Whitney, Advisory Group CEO. Meredith, it's good to see you. I mean, these numbers are pretty astonishing in terms of the ages, right? If you take home buyers overall, not just first time, the age is 59.
Up 50% from 2010. Yeah.
Yeah, it is astonishing. So what can be done? Or do we just have to wait around for rates to come down?
I think, one of the biggest problems is that over 60% of homes are owned by people over 60 and they're not moving. So they, by and large, own their homes full out. And for them to downsize, they're not getting much on a value basis for them to downsize. So they prefer to age in place. That keeps the market pretty gummed up. So there's even less inventory than there would be otherwise. There's obviously a shortage of housing inventory, but existing homes, there's a gummed up market, as you said, because people are aging in place. They don't want to sell. So one thing that I think is interesting, a couple of things have been floated over the last week, which is a 50-year mortgage, which doesn't make much sense to me, or a portable mortgage, which I'm not exactly sure how that works. But one thing that is encouraging is that something that was passed in the Senate Banking Committee over the summer in July, which is the reinvention of the American Dream Act for housing. And so what it focuses is insofar of what the federal government can do, which is limited, which is, let's say, 20 to 30% of the pain. Most of it's a local problem, a regional problem, is getting rid of a lot of the red tape and encouraging funding programs and grant programs for the states that are really going to accelerate housing programs and build more housing. And there's a big emphasis on manufactured housing, which is over a quarter cheaper than the site-built, stick-built homes. And I think that's going to be a big way forward for housing, which is just build much more affordable housing and then get government programs to incent more opportunity zones and smaller lot sizes. There's a lot that can be done, and kudos to the bipartisan passing of the bill in the House Banking Committee. That moves then to the larger Senate and then the House. Obviously, the House Banking Committee is going to have to take a close look at it, but it looks pretty good, and I think that's probably a better step forward than what seems to be a quick fix, but not a very realistic quick fix in terms of a 50-year mortgage or a portable mortgage.
Why is a 50-year mortgage, in your view, not a good idea?
It doesn't really lower the cost. I mean, to me, you've got to do two things.
Doesn't it increase the cost? Potentially?
It doesn't. it doesn't necessarily lower the cost competitively for a 30-year mortgage necessarily. You're paying down a lot of interest. You're not paying down a lot of principal with that structure, and you're not building a lot of equity, which is what the American dream is all about. So if you look at seniors, I always go back to seniors, which again own 60+% of homes. 79% of them, 76% of them own homes without a mortgage. So they bought their home likely with a mortgage. They paid down because they paid more down in principal than in interest. A 50-year mortgage works the opposite way. So it's not clear that it lowers costs. But again, the you've got to have two things. They're not mutually exclusive. You have to have home prices come down, and you have to have rates come down to make housing more affordable. You just can't have lower rates and have home prices stay so stubbornly high. So home prices have gone up over 45% since 2020. And so there's softness in the Texas market, in the Florida market, but overall home prices are still stubbornly high. And that's keeping a lot of, as you led the segment on, first time buyers out of the market. I think a lot of what I call avocado toasters, which are a combination of younger millennials and Gen Z, think that perhaps the American dream is just out of the realm of possibility, and that they'll be renting for their lives. And maybe that's not a bad thing, because renting has actually been cheaper than owning because of the high prices associated with homeowners insurance and overall cost of maintaining a home.
Now, barring a regulatory solution or a legislative solution, like you mentioned, like in terms of market dynamics, what would need to change? Obviously rates coming down would help, but how much do rates and prices need to come down, and what's going to get them to come down?
Well, I mean, sorry, I hate to use this. More sellers than buyers always gets the market to come down. There are more buyers than sellers right now, and so that means that home prices are going to be higher for longer. And then, of course, rates coming down by at least 100 basis points. That would be, I'm going back to when the last time the housing market was hot was 2020, very early 2021, and rates were lower and home prices were a lot lower. So even if you had a medium correction in home prices of 10%, that would help a little bit. But again, we have more buyers than sellers, and that this is again because seniors are not doing the things that they used to do. This housing market is unlike any housing market before, because you have fewer people getting married, you have lower homeowner household formation rate, and then you have fewer people selling and downsizing. So more people are aging in place, and more people are living alone for longer. So 26% of adults live by themselves. That doesn't help the housing inventory very much. It's, Harvard Joint Housing Study says that only 1 in 10 seniors can afford to live in assisted living. And for that reason, a lot of people are stuck in their homes. So it's a multi-pronged and complex problem to solve. And a lot of it's going to have to do with zoning restructuring, local reforms, federal reforms, and it's not, again, there's no quick fix.
Speaking of no quick fix, the last point that you touched on about the affordability of assisted care for people who need it, right? Does there also need to be sort of a policy prescription to deal with that because of the aging of Americans and people not being able to afford that kind of care? So then, does that have the dual effect of helping elderly Americans and also loosening up the housing market?
Yeah, I think that there's some really creative, solutions. So there's been a chronic undersupply of home health care aides, and that's not improving with a slowdown in immigration, because so many of the healthcare aides are foreign born and guest workers or on their path to citizenship, and that has been, and as more people, as the silver tsunami, the majority of the boomers have passed the threshold of becoming seniors, that only amplifies the numbers. So I have written extensively about a Golden Girls type housing arrangement where you have shared housing in single family housing and you'd have shared home healthcare workers. You got to think of new strategies, but not only is aging very lonely, and loneliness is a major contributor to aging faster. That a shared housing agreement helps that, also shares expenses, and also helps with the healthcare shortage. But creativity is critical here, and there's got to be a lot of optionality, and everything that needs to be on the table.
I love the Golden Girls solution, Meredith. That's a good one. Thank you so much. It's great to see you.
Great to see you, Julie.
Thanks. Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check in the markets here. We have them trading lower at the moment. We've seen a little bit of volatility bouncing around between gains and losses today, but both the gains and the losses have been relatively small. We've got, of course, a couple of big events this week that we've been talking about. We've got the delayed September jobs report coming out on Thursday morning. And before that, we have Nvidia's earnings after the close on Wednesday. Those really the two big events of the week. Walmart also earnings Thursday morning. That will not be a small item either. So ahead of that, it looks like folks are kind of waiting for those big catalysts for the market. And last week's sell-off aside, the world's biggest tech companies, of course often called the Magnificent Seven, are the locomotive that's been powering the markets. And to some people, they're here to stay. But our next guest says not so fast. Market history tells us that big dogs rarely stay on top. Joining me at the desk, Rob Arnott, Research Affiliates founder and chairman of the board. Good to see you, Rob.
How are you? Good to see you.
So that is a bit of a different question than the bubble question that we've been, talking about and debating ad nauseum. Mm-hmm. Rather, it's are the giants of today the giants of 5 years from now, or 10 years from now, or 20 years from now? And no. I guess we can look back to look forward.
Short answer is no.
Okay.
If you go back historically, take the 10 most valuable companies on the planet, decade by decade, 1980, 1990, 2000, 2010, 20, and today. 2 or 3 of the top 10 are still in the top 10 10 years later. Never more than 3, never less than 2. If you take the 10 largest US market cap stocks, 3 or 4 are gone within 5 years in every single 5-year span in the last 50 years. Every single 5-year span, 3 or 4 are gone in just 5 years.
Gone out of that top.
Out of the top.
Yeah,
not gone,
right,
but
yes.
Change is normal. Change is the essential element of a healthy capitalist economy. And creative destruction is normal. Disruptors get disrupted. You look at the most valuable companies on the planet in the year 2000. Number 1 was Microsoft, still in the top 3. Pogo's around, but it's still in the top 3. But interesting, you had to hold it for 18 years before you were ahead of the S&P.
Well, and you would have had to have held it through its Department of Justice, the whole monopoly. That would have required a high degree of conviction.
Lousy stock in the 2000s, great stock in the 2010s and 20s.
Right.
But 18 years is a long time to wait. That's the only stock in the 10 most valuable tech stocks in the world in 2000. The only one that beat the S&P over the next 20 years.
So how do you know which one to pick now? That will be that one.
You can
or you don't.
Try to pick the one, or you can just say, if it's a top dog today, chances are it's a little overpriced. Chances are it is priced for perfection, and some of them will achieve it and most won't. So maybe I should just go light on those. Back to the year 2000. Number 2 on the list was GE, not really a tech stock, but cresting on its way to irrelevance. Number 3 was Cisco. Cisco is still lower than it was in the year 2000. It was priced for 40% per annum growth. It had a quarter century of 8% per annum growth. 8% is wonderful, it's just not 40. Number 4 on the list was Intel. It had a moat. It was the dominant semiconductor and chip producer on the planet. Nobody could touch them except AMD, ASML, Taiwan Semi, and now Nvidia. It's now number 5 chip producer in the world, and even $50 billion from the CHIPS Act couldn't put them back on track. Next on the list was Lucent, gone.
Right.
Next was Nokia.
That one actually is gone. Pretty.
Yeah.
You know, that one didn't just fall out of the top.
Next is Nokia. They still make phones. Hallelujah. So Nokia, 6th most valuable company in the world in the year 2000.
Okay, so if you don't then over-index to those biggest of names, what do you do? How do you try and figure out either who will be the biggest coming up, or, you know, capture ones that do have significant upside?
Figuring out who will be the biggest is a wonderfully fun parlor game. The likelihood of guessing right on that is pretty low. I would just fade the top dogs. That is to say, go underweight, and if they keep soaring, go underweight a little more. Just like averaging into a falling market is a wonderful strategy, averaging out of a frothy market is a wonderful strategy. We're in an industry where people love to chase past winners. We're in the only major industry in the global macroeconomy where people hate bargains. A bargain got there by inflicting pain and losses to become a bargain. Nobody wants pain and losses, even if it's already happened. And so this is where opportunities to do better come in. We invented fundamental index 20 years ago. It has a stark value tilt, but it also has a rebalancing discipline. If a stock soars and its fundamentals don't validate that price move, you're going to say, thanks for the nice gain, I'm trimming it. If it tanks and the fundamentals don't validate that drop, you're going to say, thanks for the bargain, top it up. And the result is that RAFI has beat cap-weighted value indexes in 15 out of the last 20 years.
Has it beat the S&P 500?
No, it has not, because it has a value tilt and value has been getting cheaper and cheaper. I wrote a paper in 2021, Reports of Value's Death Have Been Greatly Exaggerated. And in that paper, we showed that the underperformance of value from peak in 2007 to trough in 2020 was entirely due to value stocks getting cheaper relative to their fundamentals, not to their fundamentals underperforming. Century to date, the earnings and dividend growth of Russell value have almost exactly matched the growth of earnings and dividends for Russell growth.
I mean, I guess what you're saying logically makes sense, but again, why not just buy the regular market cap weighted index?
Cap weighted indexes have 2 Achilles heels. One, they link the weight directly to the price, which means that if the stock is overpriced, it's overweight in your portfolio. Fundamental index addresses that with a rebalancing discipline and a value tilt. If you want a value component in your portfolio, why would you do it any other way? Indexes also have a second Achilles heel, which we addressed in introducing research affiliates cap-weighted value, changing only the selection discipline for what stocks are included. Instead of including stocks that are, let's say, in the top 500 by market cap, we choose companies that are in the top 500 by the scale of their business.
Right, and this is something we talked about the last time you were here because you were just coming out with it. RAUS is the ETF.
That's exactly right.
So how is that done? I mean, it's a baby. It's
a
very
baby.
new.
It's tiny. It's about 20 million AUM. It's 9 weeks old, and unlike most 9-week-old toddlers, it's growing really fast. but it's already edged past the spider by 29 basis points in its first 9 weeks. And that's wonderful. That's 3 basis points a week. That adds up. And it does it with 99.96% correlation with the S&P 500. There's 95% overlap between the two. We don't include small companies that are trading at frothy multiples. The biggest market cap stock that's not in our index and is in the S&P is Palantir. Wonderful company, beautiful, well managed, great growth engine, priced for perfection. Reached a market cap of $500 billion with trailing 12-month revenues, not profits, revenues of $3 billion. How do you justify $500 billion value with $3 billion revenues? Tacitly, you must be assuming the $3 billion grows to $30 billion, to $60 billion, to $200 billion, and profits accordingly. If that doesn't happen, then what you have is a bubble stock. I think it's a bubble stock. I think it's a great company priced for something beyond perfection. Somebody in the dot-com bubble coined the expression that some of these stocks are not just priced for the future, but for the hereafter. And I think Palantir's an example that's probably priced for all of the future plus the hereafter. Great company, great product. Is going to be an important company 10 years from now, probably, but is not going to have 200 billion revenues in the next decade.
Well, Rob, we got to leave it there, but come back when Rouse is, I don't know, elementary school aged, and we'll check in again to see how
I think it'll be elementary school aged within 6 months, so I'll see you then.
Okay, thanks, Rob. Good to see you. Thanks for coming in. Coming up, we'll have the co-founder of Vita Coco joining me in studio, the company getting some relief from tariffs. Stay tuned. You're watching Market Catalysts. Vita Coco shares are rising after the company released a statement on tariff relief, saying the average tariff rate for its products arriving in the United States will decrease from the previously announced 23% to about 6%. This comes after the White House announced relief from reciprocal tariffs for certain agricultural products. That includes coconuts and coconut water. Joining me now is Michael Chikaiban, of the Vita Coco company co-founder and executive chairman. Thanks so much for being here.
Thanks for having me.
So 6% is obviously better than 23%.
It is better, yeah.
But you also said in the statement that you're kind of locked in for the rest of this year. So presumably this will start to benefit you next year.
Correct. Yeah. I mean, we've been paying tariffs on incoming product for the past months. And we have inventory. So this is, it's not going to be very meaningful or material to this year. It's really going to be helpful in 26, both for the company, but also we were planning a large price increase for next year. So now we can continue to offer, healthy hydration to consumers at fair prices, which we're excited about.
Had you already raised the prices this year to account for some of the tariffs?
We took some small pricing earlier in the year to mitigate the initial 10% baseline tariff that we had seen. But that covered a small portion. So, yeah.
And you all, it's my understanding you also did quite a bit of sort of jigsaw of your supply chain. So what did you do, and what does that unwind now look like?
So it's not really an unwind. Actually, as of now, there's still a tariff on Brazil. Most of what we were doing is trying to move production from Brazil, supplying the US to supply Europe and Canada, so that we didn't have the 50% tariff that we were looking at from Brazil. So now that there's zero tariffs coming from all other places, and still 40% from Brazil as of now, we'll see what happens, it actually worked out quite well, because now we can supply some of our European business and some of our Canadian business with Brazil product.
Talk to me a little bit about how coconut water is made. I mean, besides just cutting open the coconut, like how many coconuts do you need to make a carton of Vita Coco?
So 1 carton of Vita Coco is just over 1 coconut, but we're cracking 4 million coconuts every day for our water. Wow. And a tree, you'll typically climb a tree and get 4 or 5 coconuts out of a tree at one climb. So think about how much that is throughout the course of a day and the course of a month that farmers are picking coconuts to supply the market.
And do you guys own your own supply, or are you buying from farmers?
We buy from local farmers. Most of these are small family farmers. One brother might climb the tree and the other brother fishes, and that's how they support the family. And so we've done all these programs in these farming communities, from agricultural programs, helping plant seedlings and helping improve yield on the farms, to building schools for the kids in these communities, specifically in the Philippines and Sri Lanka. So it's an amazing thing to be able to build a business, a profitable business, and be able to actually give back and uplift communities.
Yeah, and how do you think about sort of sustainability of the coconut farms that you're sourcing from also?
I mean, the beauty of coconuts is you don't cut down the tree. And it's harvested all year long. And the water historically was a byproduct. So we're now taking a byproduct of the coconut manufacturing business and upcycling this byproduct and offering a market for it. So increasing the value of each coconut that's picked.
So Vita Coco, I think most consumers are familiar with your product now. You guys have been around, what did you say, since
21 years.
21 years.
Yeah.
How did you come up with this idea?
It started in a bar, but it really ended up on a beach, drinking out of a coconut and seeing coconut water in Brazil. This was in Brazil. Coconut water everywhere. People were consuming it for hydration. I mean, this is a product that has 3.5 times the electrolytes of a sport drink. So it's incredibly hydrating, incredibly functional. They're also mixing it in cocktails. They're also drinking it for a hangover. They're drinking it in their coffee to make cold brew out of coconut water. So all these usage occasions, and it didn't exist at home. So we were thinking there's got to be a market for it. We thought maybe we could build a coconut water market in New York. That's where I lived. And I brought it back, created a brand, brought it to the US. We started selling it, and now we're operating in 30 countries and building what has been, I think, for a lot of the last 20 years, somewhat of a niche category. Really feels to be transitioning into a mainstream household staple across all of our markets, whether it be the US, Western Europe, Canada, whatever it might be.
And you guys are also expanding more into other coconut-related products, right? So how is that, what sort of percentage of sales at this point is the core coconut water versus these other products, and how big do you think they're going to be?
So the vast majority is the core coconut water, as coconut water becomes, like I said, more of a household staple. But we launched a product this year called Vita Coco Treats. It's a coconut milk-based product. It's quite indulgent and delicious. It's skewing very young, after school, grabbing a hydration treat, and it's coconut milk based. And if we think about, for example, our growth in syndicated data, it's adding about 4 or 5 points of growth to the total beverage business for us.
I was looking at one of those products this morning. There's a lot of sugar in there. So it's definitely quite different.
Vita Coco Treats.
The treats. Yeah. In terms of the difference between what I think of as Vita Coco as a healthy product, as you say, more of a sports-oriented, versus these treats. Do you worry at all about sort of brand bleed over, considering it is not a healthy thing?
It's not unhealthy. Yes, it has sugar, but it is, it's coconut water, coconut cream, it's natural products, there's nothing artificial in it, and it's just a delicious product. And we're seeing, as you look around the world, if you look in China, for example, you go into a coffee shop, 5 out of the top 5 beverages are coconut milk-based products. They're not coffee-based products. So people are using coconut milk as a refreshment, as a product to drink, for an indulgent type of refreshment product.
Is there any plan going forward? I mean, Vita Coco, I have to say, talking about it with the team after we booked you to come on and talk, you've been public since 2021, and I think there was a little surprise among people that you weren't part of a bigger beverage conglomerate. How do you think about whether you want to stay independent and those types of opportunities?
Well, I think the category is in its infancy. So if I'm thinking about long term, I started this business with a friend of mine. We still operate the business, and we've built it into what it is today. And I think about the business long term, I think there's just so much opportunity to continue to grow coconut water as a household staple, and more consumers using it for more and more occasions throughout the day. I like it, I mean, I could, operate the business as a public company. Shareholders can come and go. People can have liquidity when they want liquidity. So it's a really nice, I think, way to operate and build a business for the long term.
And finally, you and I were chatting during the break. The stock is near a record, we should mention as well. And we were also talking about how a lot of companies that came public in 2021 have had very volatile journeys. So how do you think about the stock? I mean, you must be happy that the stock price is where it is.
Yeah, I'm happy the stock price is where it is. It's performing well today. But to be honest, it's about growth. I mean, we grew 37% in the quarter. We're up 20-something% year to date. There's nothing outside of tech that's growing like that. So I think when you're growing a business this fast, investors are excited about it. And we see a long runway of continued growth as we continue to expand globally and build the business here in the US. So we're excited to see that continue to develop.
Have you seen any kind of, I mean, we talk a lot about the K-shaped economy here. Have you seen any kind of demand erosion, particularly for lower end consumers?
We haven't. I mean, with that type of growth in consumer, if you're losing some consumers at some level, it's hard to recognize when the brand is growing so fast. But I think today people are paying for functionality. If you look at beverages, protein, energy, and coconut water are the only things that are really growing in the beverage aisle, and those are the most functional products, and they're also not the cheapest products. So people are spending, they're digging into their pocket to spend on things that actually function and work for them, like coconut water as opposed to a sport drink, for example.
Michael, thanks so much for coming in.
Thank you.
Appreciate
Thanks for having me.
We got much more markets action coming up. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Ali Canal, live at the NASDAQ. Let's get a quick check on the market action about 2 hours into the trading day. And you're still seeing red across your screen when it comes to the three major indexes. The Dow is off around 160 points. The NASDAQ and the S&P 500 both off roughly 0.3%. We seem to be off of the lows of the session. Early this morning in pre-market trading, futures were indicating a higher open, but we are now dealing with a lot of red across the screen at this point. And it comes as there's been a lot of question marks around the sustainability of the tech trade. Valuations remain hot. Positioning remains very concentrated and crowded within those AI semiconductor names like your Nvidias of the world. So there's been a lot of further debate over whether or not we're in an AI bubble. But speaking of Nvidia, that's going to be the next major catalyst for the market. You're seeing shares down around 1.6% today. Year to date, we are still in the green, up roughly 40%, and we have Nvidia earnings on Wednesday, and investors will be really looking to this report to confirm that AI demand is still alive and well. But it's not the only big tech stock making headlines today. We have Google shares that are up 50% year to date, and on an intraday basis, we are up 4%. And this comes after Berkshire Hathaway disclosed it has taken a nearly $5 billion stake in Alphabet. The move, which is likely the last under Warren Buffett's leadership, is a rare tech bet from the conglomerate. We don't typically see this, but it's helping boost shares of Google today. Now, outside of those names, we have a bit of a mixed bag across the Mag 7 players. Apple is down nearly 2%. Microsoft off around 0.6%. Meta off 0.5%, and Tesla is up around 3.5%. Now, outside of the major indexes, Bitcoin is a currency that we've been keeping our eye on, a cryptocurrency that really has just been brutalized in recent trading. We are firmly below $94,000 a share. Year to date, we have turned negative. We are now down 1.3%, and it comes after a lot of volatility in this name, and that's affecting other types of crypto adjacent plays like Strategy and Robinhood as well. So something that we're going to continue to keep an eye on. Bernstein was out with a note this morning saying that this market weakness may provide an attractive entry point for some investors. So we'll see if we can get back into the green for the year. But for now, keep it right here on Yahoo Finance. We'll be tracking all the major market moves throughout the session.
Now time for some of today's trending tickers. We're watching Amazon, Xpeng, and Netflix. Amazon, the e-commerce giant, looking to raise $12 billion through a bond sale, according to Bloomberg. That would mark the company's first bond sale since 2022. According to sources, proceeds from the offering may be used for everything from acquisitions and capex to share buybacks. Amazon's bond sale adds to a wave of massive technology debt offerings as companies race to fund AI infrastructure. Next is XPeng. The Chinese EV maker reported fourth quarter revenue that trailed analyst estimates. XPeng did, however, post a better than expected loss in the third quarter. Analysts had projected it would start making a profit from the first quarter of 2026, those shares tumbling by more than 7.5%. And Netflix, those shares are trading for the first time since its 10-for-1 stock split went into effect. The video streamer announced that split, remember, in late October. Every shareholder of the stock has now received 9 additional shares after Friday's closing bell. And a reminder, splits don't change the value of the company or the dollar amount of equity that each shareholder owns. They're designed to reduce a stock's price to make it more affordable for individual investors to buy more entire shares. Those shares little change today. Coming up, we got much more markets action, including the return of stocks in translation with our own Jared Blickery. Keep it right here. The AI trade and the future of the technology was in focus at our annual Invest event last week. Yahoo Finance executive editor Brian Sozzi spoke with Reddit co-founder Alexis Ohanian about everything from valuations to risks to the labor market. Here's a part of that conversation.
You're a father of young children. What is this AI revolution? What will it mean to how they learn? But in addition, what does it mean for that generation, their ability to find jobs 15, 20 years from now?
Well, okay. So on the latter point, I don't know. I want to believe I'm a tech optimist, and I do think more new jobs will be created than removed from the system. I think an easy example, we were fortunate to be early investors in a guy, Mr. Beast, 5 years ago. The idea of being a content creator, let alone a billionaire because of it, was unthinkable, 15 years ago, 20 years ago? And now it's probably one of the most common professions that a young kid, at least in America, wants to be when they grow up. So there is precedent, right, for, social media, that revolution was a significant one, not nowhere near as big as AI, but it was one that created entirely new career paths, sectors, industries that didn't exist before. And with every technological revolution, there's always new careers, new things that come up that you or I can't necessarily think of. The builders are going to build and do. And so I'm hopeful there are going to be more new ones created. We actually just in DC with one of our companies, Area 2 Farms, where they're franchising vertical farming. And when they talk about what is needed to manage a vertical farm, especially in a dense urban area where you don't have a lot of space, and because it's more vertical, you're going to have a whole new trades of people who are working on the robotics that help manage those farms and make sure the lettuce, grows on time and whatnot. And so again, we're already seeing AI, robotics, they're two sides of the same coin, creating new jobs, new opportunity, new innovation, better quality of life, right? Everyone deserves access to high quality, well-grown produce, right? Whether you live in a rural community, whether you live in a city. And so I feel like it'll be a net positive. That doesn't mean it won't be a bumpy road. And, how do I prepare my 8-year-old and a 2-year-old for this? I've already been paying attention. I've been tweeting about things like Alpha School, which I think are taking a really smart first principles approach to education. I do think the future of education for, let's say, K through 12 looks a lot more like having guides instead of teachers, and that's verbiage from folks like Alpha School and Prenda, where your personalized AI tutor is doing a lot of the instruction, right? I'm a big Duolingo user. You're familiar with that. That is probably the
great platform
expression of that, right? And there's no reason why a kid, regardless of their background, regardless of their home life, shouldn't be able to get personalized education. So if they need extra help with a certain part of math or a certain part of English, fill in the blank, you're going to have AI solve those problems for them, giving them that infinite access and infinite patience to support and customize learning. And then hopefully those kids get to spend the rest of their school day actually interacting and building up their emotional intelligence and solving problems. And I think the school of the future should really optimize the time with the AI to help learn, but also maximize the time off a screen so that kids are getting the things that can continue to be valuable when they grow up.
Alexa, let me channel the sports side of your brain. And earlier on today, I had a really good chat with Ted Leonsis, owns the Wizards, several other teams. His portfolio is valued at, I believe, close to $8 billion. We mentioned the Lakers, valued at close to $10 billion. You have been an early supporter, investor of women's sports. When in the world is this valuation gap closed between women's sports and some of these mind-blowing valuations on the med side of the equation?
Look, it's coming quick. My tweet about how undervalued women's professional sports was in March of 19 went viral for all the wrong reasons, right? Everyone, I said this is a massive opportunity. I said I was going to either start or buy. It was an NWSL team, professional women's soccer team, and one day it was going to be worth billions. And most people said I was an idiot and no one watches women's sports and that'll never work. And I said, save those tweets. And he ultimately paid a little over $1 million for the expansion fee to start Angel City FC. And in the wake of that success, right now it's valued at the most for any American women's soccer team. Arthur Blank in Atlanta just paid, I think, $160 million for his expansion fee. So that's quite an appreciation over just 5 years. And so it has been really validating to see, to call the shot, to spark that and see the growth. But I think anyone will tell you it's just the start. There is so much more room to grow. And remember, most of these men's teams' value is based on media deals that have been baked over decades. And, whereas for women's sports, when we're building a team, I just bought the LA franchise of League One volleyball. And it was just like 2 weeks ago, so hot off the press.
Congrats. Wow.
We build out, thank you. When we build out the structure for how to build that team, most of our revenue is not going to come from a media deal. Most of our revenue is going to come from brand deals. And so we've been able to build, Angel City's doing tens of millions of dollars in revenue a year. You're seeing a precedent here for more and more women's pro teams to basically build the muscle of revenue generation in a way that's much more about, business, right? It's about how do you drive revenue through brand partnerships and all these things that it turns out lots of CMOs are excited by. And the media deal is still down the road. So you have to earn that media deal through the viewerships, but the brand dollars obviously help you build the brand and prove the value. And it's this virtuous cycle. And you've seen that in the rapid ascent of WNBA team valuations and revenues. And I think, it won't be for every sport, but you can see the places I've been investing, obviously also starting a Formula One for track and field like Athlos. That's an entire league where I've seen this same opportunity that I saw with women's soccer, where the World Cup showed up every 4 years and then everyone was watching and then they all disappeared. The thesis was simple, why not make sure they don't disappear and keep investing? Similarly, track and field is the #1 Olympic sport. These athletes are superstars and then they disappear. They shouldn't disappear. So we built Athlos and 4.5 million people tuned in for our New York meet just a month ago. And we're rolling out a multi-meet league next year with teams. So I'm excited about all this. I think at the end of the day, we're only 5 years away. I think 5-6 years from my tweet. And I think there is still so much more room to grow in women's sports. I think we will absolutely see billion-dollar women's sports teams as I had laid out, and I will be sure to rub that in the face of all those haters on Twitter 6 years ago.
Last one, and I wanted to save this one, Alexis, because I think this is also in your wheelhouse, and it's also in the wheelhouse of my dear friends at Yahoo Sports. Why are collectibles having a moment, and what is next in this industry?
It has been an amazing ride. We love our partnership with Mantle and Yahoo. We've got some hobby awards right now, actually. I think this industry is starting to professionalize, right? The hobby was always a very mom and pop type business. And during COVID, everyone was locked down. Everyone was feeling pretty anxious, and nostalgia became really, really desirable. And so that's when I got back into the hobby. I collected cards as a kid, like a lot of kids in the 90s. I thought that collection was going to help me retire one day. It did not.
Friday felt like the market touched an electric fence. Early on, big names like Nvidia, along with the entire sectors and markets, slipped under a key level. But by day's end, the pros had pulled them back to safety. On today's Stocks in Translation, we are going to break down the 50-day moving average. Let's start with a quick definition. Here we go. In technical analysis, it's the average of the last 50 closing prices. It moves a little each day as new data comes in and old data drops out. And traders, they treat it as potential support or resistance. And when everyone can see the same line, it starts to act kind of like an electric fence. You can test it, but if price starts living on the wrong side of that fence, people pay attention. And now a quick example. This is going to be the S&P 500, and this goes back to the beginning of the year. I'm going to throw on the 50-day moving average here. You can see that has been added in blue, and it's been in play over the last few weeks, especially last week and the last 2 Fridays, like I was saying. But it's not only the S&P 500 where prices managed to stay above this line, it's also the Philly Semiconductor Index, the SOX as it's known, XLK, the Technology Select Spider Fund, and Nvidia, the kahuna of the AI trade itself. Now, Kenny Polcari and I were watching the S&P 500 near its 50-day during Yahoo Finance's Invest Day. Kenny spends a lot of time talking about these things on his Trader Talk podcast on Yahoo Finance, and he was telling us why you want to watch the price action when it gets close to this average.
What's going to be important in that is, does it hold or does it fail? If it fails, here's what typically happens. You get the algos that will kick in because we've had a technical failure on the chart, and then you'll get the algos that just operate based on a mathematical formula that will see that there's a failure and they'll go into sell mode, which will end up putting more pressure on the stock.
I love that because that's exactly what happened early Friday. The algos sold hard as the fences seemed to break and scared off those weaker hands. But by the end of the day, the pros stepped in and closed all the key markets above their averages, restoring those protective fences. Now, here are the ways the pros are using the 50-day moving average right here. First, they treat the average as potential support or resistance. Potential. If price has been riding above it, that line is often the first place where buyers step in. And if we've fallen below that line, the same line can turn into a ceiling. Next, watch how price and volume react intraday when the level is hit. Do you see a quick reaction off of it, or does price cut through it like a knife through, like a hot knife through butter? Then, is volume confirming or denying? All of these are clues, and the pros are also going to gauge the slope of the average. Is the 50-day tilting higher, rolling over, or just flattening out? A rising 50-day with the price above it is a very different animal from a flat or a falling 50-day that's being poked from below. Next, they use it with other signals, especially the 200-day or other moving average timeframes. You might have heard of the golden cross or the death cross. That's when the 50-day crosses above or below the 200. And then finally, there's the nerdy side. A lot of other indicators are built around these tools, the moving averages. For example, you can measure how far price is trading above or below the average, which helps tell you if the market is getting overbought or oversold. All of this now is just scratching the surface. So what are we going to watch from here? Well, let's get back to our slideshow and see if we can find our requisite slide. And little technical problem. We'll see if we get beyond this. There we go. What to watch next? First, does support turn into resistance? If key stocks and indices start trading below their 50-day, which seems to turn into a ceiling, that is a big tell that markets are reversing lower. Second, watch those slopes. You want to see a rising line that keeps catching a lot of buyers, not a flattening line that cannot contain price. Then, are those dips getting bought with volume, or is participation, aka volume, drying up? And finally, how many stocks are still above their own 50-day? If the majority of S&P names are holding that line, the fence is still doing its job. But if that number starts falling, the story might be changing. So here's the bottom line for investors. The 50-day is a very simple tool with a lot of nuanced uses. When lots of big stocks and indices manage to hold it when it's tested, it's a sign that the pros are still defending the trend. And when they step back and let price live on the wrong side of that fence, that's when the story tends to start a new chapter. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts up next.
Walmart and Target both set to report third quarter earnings this week. Investors will be listening closely to see how much consumers are spending and for the holiday shopping outlook for both companies. Here with more on what to expect from these results and how consumers are holding up, Jessica Ramirez is here with me in the studio. She's the Consumer Collective co-founder and managing director. Thanks for being here.
Thank you for having me.
So we have these companies coming out this week. We've seen Walmart pretty consistently performing better than Target, although both of them are now going to be undergoing leadership changes, right? But what should we be paying attention to for these companies this week?
I think Walmart has the upper hand in a lot of this. They have been taking market share from Target for some time, almost a year really. I think they are well positioned. They have the high income consumer, which they've been taking advantage, and also evolving the rest of the category. So there's a reason for them to stay outside of just grocery. And they also have middle income and low income, where I feel with Target, they are still much more discretionary. exposed, but at the same time, I've seen the store experience and also the product starting to dwindle, which again isn't really boding very well for them. And in terms of price sensitivity and convenience, I feel like Walmart is still the winner. And like I said, they've evolved across their discretionary categories, beauty categories looking fantastic there. Their apparel is looking really good, and they've really been focused on that. And again, I think that's the advantage Target used to have, where now Walmart is that one-stop shop.
So what does Target need to do then? Like, what are you going to be listening for when they report earnings and have that conference call to help convince you that they're going to make progress in this area?
It's interesting to see where just last week, I believe, the weeks are going quite quickly, they talked about bringing down their price. But again, if I'm starting to see some of that quality dwindle, it's questioning, and I think they probably will be taking hits on their margin. I think that's part of where we're going to also see, even with Walmart, where are tariffs starting to hit. Again, Walmart does have the advantage of that higher end consumer and just coming in more. And they have the media arm, which is doing great for them. Also the marketplace, that's really ramped up for them in terms of partnership. But with Target, I think some of it needs to ramp up a bit more. And again, just questions around service and what that's looking like in store, because as they are letting go of people and they're going through this turnaround, I think it's going to be a bit tough in the beginning.
Let's look ahead a little bit more broadly as well to the holiday season, because you guys just did some survey work on what people are planning to spend, because we know consumer sentiment is not great right now. So what did you find?
Yeah, so it was interesting to see. We were mostly curious because from third-party services, we had seen, the top 10% is spending 50% of retail sales. So that made us question, what about everyone else? So we surveyed what would make up 45% of American consumers today in terms of household, and they're not looking too hot. Interestingly enough, they were looking more for value, and so they're looking for promo. So unfortunately, right now, I'm not seeing a lot of promotions. The promotions we saw were in October, so we likely do feel there's a pull forward. They did say 2/3 of the 1,000 consumers that we surveyed said they were already either shopped for ahead of Thanksgiving for Christmas gifts, or they were going to wait just before Thanksgiving for that value. The other reason the other item we're still seeing is if they're not getting the promo out, they're looking for quality. So is this brand something that I'm loyal to? Is the quality really there? Then I will spend that extra buck. They're really focused on paying the rent, paying groceries. So again, those essentials is really priority, but they are saying, almost everyone across the board said, it's expensive. Yeah. Everything is really expensive right now. They're taking out new debt. They are getting more debt. So if we look at buy now, pay later, that's increased. But again, we're seeing those numbers and that debt also increase there. So I think it's a really difficult time for the consumer, and there's only been more that's been mounting in recent weeks for them.
So how is that going to translate then into individual companies during the holiday season? I know, for example, you're paying attention to the off-price retailers, right? That they might benefit from this.
Yeah, so TJ is really well set up. I mean, TJ has been a winner in off-price. Burlington has actually been turning around in terms of their strategy. Merchandising is looking much better. I've been walking the stores and store checks, and to be quite honest, they look really good. I think they're the best positioned. But across the board, I feel a lot of the brands and retailers have been listening to consumer interest, and they're headed in the right way for trends. So if I'm talking about denim still has legs. There's a lot of newness that they've added in denim. Leather, there's been more. I was talking about the biker jacket being like the skinny jean, and then now we're having bombers in terms of leather. So again, there's newness out there that the consumer could gravitate toward and maybe see to spend on maybe one item or two items. And they did say clothing is a top priority for their spend this, so either for themselves or for someone. So I think they're well positioned in that in terms of having what consumers want, and also in terms of beauty. Like TJ's doing great with beauty for both TJ Maxx and also Marshalls, which again for Target, they used to be that standout for beauty, but now everyone's really gone into it. And actually beauty is the one that I am seeing discounted because there's so everyone is doing beauty.
Yeah, so they have to set themselves apart. This makes me want to go shopping. Jessica,
anytime.
Thank you very much. Appreciate it.
Thank you.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.